Silver just snapped back hard, up roughly 20+% in a day, and the next 3 weeks could decide whether this was the low or the calm before another drop. As I'm recording, the move off the lows is violent. We're talking mid-60s to high 70s, and overseas pricing is even hotter. At the same time, Bitcoin just ripped back above a major round number after a massive daily surge, and equities basically erased yesterday's scare in a blink. That kind of synchronized whiplash across metals, crypto, and stocks isn't normal noise. It's a signal. But of what? Quick safety note. This channel, Vantage Economics, will never ask you for money, links, or verification fees. If someone pretends otherwise, it's a fraud. I'm here to work through evidence, not to sell certainty. And if you've been online long enough, you already know how this game works. Green candles get to the moon. Red candles get it's over. And the narrative flips just to keep you watching. We're not doing that. We're mapping what's happening, bull case and bear case, at the same time. Because markets don't care about our preferences. Now, let's frame the move. Yesterday's low in silver was around the mid-60s. Today, we're hovering near the high 70s. If you only consume mainstream recaps, you'd miss it, because the reversal didn't come with a clean headline story. It came with a broad risk-on snap. Crypto surged, small caps popped, and big indices reclaimed ground so fast, it felt like someone hit rewind. Why does that matter? Because correlations reveal positioning. Bitcoin spiked by 5 figures from the lows. ETH bounced sharply off a key psychological area, and short liquidations piled up in a hurry. Hundreds of billions reappeared across the crypto complex. In stocks, the bigger indexes bounced, but the real tell was smaller companies, the high beta end of the market, moving first and moving harder. That's what you see when fear gets crowded and then unwinds. Are we watching fresh conviction come in, or just trapped shorts buying back? Here's a pattern worth naming. In 2026, it's been crash, recover, over and over. At some point, you stop calling it volatility and start recognizing the incentives behind it. Not everything is organic. Price discovery gets steered, headlines get timed, and history gets edited. Yet reality eventually forces a reckoning. You can delay truth, but you can't delete it. So let's go to the data that matters for silver, because price alone can fool you. One of the loudest signals right now is the cost to borrow physical silver in London. The 1-month lease rate jumped to about 6%. That's not a sleepy, well-supplied market. If metal were plentiful, professionals wouldn't pay up to source it temporarily. A spike like that often hints the sell-off was dominated by paper leverage getting purged, not real-world demand evaporating. Another piece, silver remains in backwardation, near-term metal priced higher than later delivery. That can happen for different reasons, but in a tight physical environment, it's a classic stress sign. People want metal now, not promises later. And when prices get shoved down aggressively while physical stays wanted, inventories can vanish faster than expected. Then there's futures positioning. Look at what happened with gold open interest. It fell to levels not seen since the late 2010s. That kind of contraction suggests speculators were forced out. When that crowd eventually returns, open interest can expand alongside price. Does that guarantee the low is in? No. But it does suggest selling pressure may have exhausted itself, at least temporarily. What happens next depends on whether bids show up on weakness. Now let's talk about the drain no one wants to headline. Chinese exchange stockpiles. Since 2020, thousands of tons have been pulled down, an enormous percentage draw over a few short years. Recent daily withdrawals have been so large that if you extrapolated the pace, you'd reach problematic territory quickly. I'm not saying it goes to zero on a calendar, flows change, but the direction matters. The big consumer is absorbing metal when the screen price is low. And what do buyers do when they think they're being offered a discount? They don't panic sell, they accumulate. And that brings us to geopolitics. Tensions around Iran and oil sanctions are creeping back into focus. When that risk premium rises, precious metals often catch a bid, not always instantly, but consistently over time. The point isn't to predict the next headline. It is to recognize that uncertainty has a habit of showing up in pricing models when traders least want it to. If you're stressed about silver right now, the first question is, what time frame are you watching? On a daily chart, this pullback looked brutal. On a longer lens, especially when you compare silver to expanding money supply, this can look more like a retest after a breakout, not the end of a secular trend. And here is the psychological trick. We were at similar price levels before with totally different momentum and sentiment. Same number, opposite mood. That doesn't prove anything by itself, but it tells you how feelings can lag facts. Ask yourself, if the fundamentals didn't change as much as the emotions did, what exactly got priced in? Now, the miners. This is where many people get blindsided. In prior bull cycles, quality miners often outperform the metal by multiples. The logic is simple. If your costs are relatively stable and the selling price rises, margins can explode. Yet recently, miners have lagged, in some cases barely keeping pace with the underlying move. Why? because analysts and models tend to anchor to yesterday's silver price regime. They update slowly, like driving while staring in the rearview mirror. The potential catalyst is earnings. When producers start reporting with much higher realized prices, cash flow can look completely different in a single quarter. Suddenly, valuation spreadsheets that assumed old silver become indefensible. If you've ever watched a sector re-rate, you know what happens fast. Quiet, then all at once. Could that be setting up here? Possibly. But there's a bigger structural story too. Large banks do not have infinite balance sheets to warehouse and trade paper claims against real metal forever. When constraints tighten, the market has to reprice. Now we reach the countdown everyone asks, whispering about the next major delivery window on the futures exchange. Here's the simplified math. Open interest implies exposure that dwarfs the registered, readily deliverable inventory. We're talking hundreds of millions of ounces represented on paper versus a much smaller pool of ready supply. And deliveries in the last couple months have been unusually intense. High percentages standing for delivery compared with what many assume is normal. If even a modest fraction stands again, the required ounces could challenge what's available. That's the setup. But here's the question. Do we get a true stress event, or does the system relieve pressure another way before it snaps? Now for the honest risk section, because it's essential. Silver doesn't trade in isolation. In this environment, Bitcoin has behaved like a risk barometer. Historically, major Bitcoin bear phases have often drawn down massively from prior peaks, sometimes 3/4 or more. While each cycle differs, the historical pattern leaves room for another leg lower in crypto before a durable base forms. And if that happens, it can tug on silver sentiment too, even if silver's physical backdrop is tight. Correlation isn't destiny, but it's a factor you ignore at your own risk. So how do we hold both ideas at once without getting whiplashed? Like this. Today's rebound can be real and meaningful while still not being confirmation. Violent sell-offs often produce violent bounces. Sometimes that bounce is the start. Sometimes it's a temporary air pocket refill before another wave. The difference is follow-through, higher lows, stabilization, and evidence that selling is done. Let's summarize what we actually know right now. 1. The cross-asset snapback is undeniable. Metals, crypto, and stocks all surged together with forced buying visible in liquidations and high beta leadership. 2. Several structural indicators for silver look tight, borrowing costs jumped, near-term pricing remains stressed, and physical drawdowns in key regions are notable. 3. The delivery calendar ahead is the kind of mismatch that can matter if participation stays elevated. But the open question remains, did the mid-60s print mark the low with this rally as the first confirmation? Or are we watching a relief rally while broader deleveraging still has one more chapter? The market's loudest move isn't always the final move. Over the next few weeks, the tape will give answers. Watch whether silver holds key levels on pullbacks. Watch whether lease rates stay elevated. Watch inventories and delivery behavior. And keep one eye on Bitcoin's structure, because if risk appetite collapses again, it can drag everything down short term, even assets with strong fundamentals. That's not pessimism, that's process. If you want this channel to keep tracking the data without the hype, hit like and subscribe to Vantage Economics. It helps more than you think. And tell me in the comments, do you treat this move as the start of a base or just a bounce you'll fade?